Another day, another dollar. Trillions of dollars in options expiration is now done in what was a largely uneventful OPEX. But with the big June OPEX out of the way, the Dow Jones reshuffled, and the S&P 500 closing at another weekly all-time high, what normally comes next? Today, we're going to discuss next week. With PCE and GDP data set to be released and inflation on the glide path lower, a hiccup could derail what the bulls worked so hard to achieve. So will inflation come in cool, or will it come in hot? Today, we have both an answer to that question as well as expectations for earnings. And we have a few big names reporting this week that'll definitely move certain sectors in the market. Also, we'll be diving into the health of the labor market, where and how is big money positioned, and of course, we have to talk about the biggest stock in the world for one day on Thursday, NVDA. Will the AI giant retake the top spot, or is it down from here? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. A lot of green, a lot of red. Such goes the market. Very 50-50 action yet today, but the red, the downside being led by NVIDIA, AVGO, Apple, as well as Meta. You know, these four big names really weighed on the index today when we saw stuff like Microsoft, Google, and Amazon really lift the index today. But it was a very half and half day. There wasn't much to go on with regards to price action. It just was a heavy volume day upon OPEX. We could see pretty much half the sectors were in the green, the other half were in the red, with the S&P 500 returning negative 0.46%, and the worst performing sectors being semiconductors as well as GDX returning 1.62% here today, and software actually the best performing sector, up 1% on the back of just some of the big names. Salesforce, ServiceNow, they produced really great gains. It was high volume trade, heavy volume trade. There wasn't much to go on. There wasn't much to go on this Friday, and today's trade was very reminiscent of what we actually saw this week. This is the weekly heat map, although a lot less red and a lot more green. We saw the same culprits: NVIDIA, AVGO, Apple, Meta produce red for the week, and then stuff like Microsoft, Google, Amazon produced green. But what we saw on Friday was very mixed action in sectors, whereas this week was actually very green here in financials, as well as industrials, healthcare, and pretty much every other sector except for utilities. And then we actually look at the last 4 days of trade, because Wednesday was a public holiday. We could see a huge difference. Only two sectors in the red: ITB, semiconductors, and that had to do with some of the data we got regarding housing starts and building permits. And then we actually just saw NVIDIA and AVGO unwind, especially on Friday, and that led semiconductors down for the entire week. So very volatile trade, and you could actually see that semiconductors was at one point the best performing sector for the week, and then NVIDIA saw a massive move down and took the entire index with it. That being said, very positive day for the rest of the market this week. Only 4 days of trade. Software up 2.78%, GDX 2.5%, discretionary 2.46%, KRE 2.36%. We definitely saw a rotation from some of these bigger names. Technology, which was the fourth worst performing sector, still positive, yes, but we definitely saw a rotation from the technology names into the broader market: discretionary, regional banks, metals, energy, financials, industrials, comm services, staples, healthcare. And that's really good to see. And that's actually what I said in my weekend video. I said we would see a flat Nasdaq 100, and we would actually see the RSP, the broader market, rally to see some better breath come into the market this week. And that's exactly what we saw. Look at the Nasdaq 100 up 0.11% for this week. But then we have stuff like the Dow Jones and the RSP up 1.8 and 1.48%, followed by small caps, a very good gain of 1% for the day. The S&P 500 did put out a pretty good week as well, up 0.76%, but then commodities up 0.64%, and TLT, the Nasdaq 100 large caps, the worst performing sector, and even bonds and commodities outperforming them. But let's hop on the chart and dive into the S&P 500. Now, the S&P 500, guys, another weekly all-time closing high. The same is true here for the Nasdaq 100, although look at this wick right here at the top. Very interesting developments, very bullish charts when you look at it in aggregate, and you don't want to fight the trend. We're looking at higher highs, new all-time highs, and higher lows all the way to where we are right now. So the trend is up. We definitely don't want to fight the trend. And if we actually have a look at some market breadth indicators, we can see some very glaring things as well. Number one, on the daily chart, this is the S&P 500. We are starting to see market breadth improve ever so slightly. and that's a very, very positive dynamic. We just want to see this continue into next week, and I do think it's going to continue. I do think you want to be in stuff like the equal weight, the IWM next week. I think we're going to see outperformance on that front. But looking at the S&P 500 here on the daily chart, we actually did have a pretty constructive week, if you ask me. Definitely positive for the week, up 0.76%, but we saw some pretty vicious sell side action here on Thursday, and then we see this doji, this indecision candle. We saw sellers come in at the top and the bottom here on Friday, but I do think that with the lack of data and the lack of earnings, the market is sort of just positioning itself next week for PCE. We do get PCE next week, as well as GDP data, as well as some key earnings from stuff like Carnival Cruises, as well as FedEx. That's really going to tell us where the consumer is sitting right now. Now, we don't have the latest gamma data. We only get that on Monday, but as it is right now, I don't think we're actually going to see the gamma core resistance move up. So I do think that up until the end of June into July, I do think that 5500 is going to act as a resistance here, and I think we're just going to trend sideways for the S&P 500. I think a very similar situation for the Nasdaq. We're just going to trend a bit sideways, and then we're going to see a bit of a catch-up trade in the RSP into next week. So that's actually what I see for the markets. I think you actually probably, if you are a bear, you can look for like short-term weakness here at the 5500 level, but if you are a bull, you want to be a buyer here at the 5400 level. So 5500 for selling, 5400 for buying. I'm personally not a seller at all. I think we are going to trade in this range for the next week into PCE, into GDP. If we get like really cool PCE data and rate cut expectations get moved up into July, then we can actually see a bit of a rally and move higher, but we are in the window of weakness, and I just don't see any more material upside into 5500 and above until we actually see the gamma flip zone move up to the 5600 and beyond. With breadth dynamics improving, if we do see markets move sideways for the next week and a half, especially the S&P 500 and the Nasdaq, that's just going to work off some of these overbought conditions. Once we get into this area, we can then continue the rally into July. So yeah, that's what I'm seeing next week is probably sideways movement, up momentum in the RSP, the IWM as well, maybe mid caps as well, fix up some of the breadth issues we're seeing, and then continue moving upward into Q2 earnings season next week. So, you want to be buyers at 5400, you want to be sellers at 5500. So we are in the window of weakness, guys. You don't want to do too much in terms of trading. You just want to hold the positions you have, because we can definitely see volatility, especially with PCE and GDP next week. So guys, let's dive into just an overview for the last year. We're about 6 months or so into the year, and we can see that the best asset class right now year to date is actually the S&P 500. Returned about 14% here year to date, and in the last month it's up about 2%. Gold, second best performing asset, and that is also on the back of gold falling 4% here in the last month, up about 12% in total. At one point it was outperforming the S&P 500, especially in April when the S&P 500 came under pressure. Then we have emerging markets, commodities, European stocks, high yield bonds, cash, US treasuries, and then investment grade bonds. And just by looking at this, it pretty much tells us one very obvious thing. Right now is risk on. Investors are favoring assets with higher potential returns. Look at stuff like equities, emerging market equities, European equities, high yield bonds, over more conservative assets like US treasuries and investment grade bonds. Now, gold is performing well. This is telling us that there is some level of uncertainty, and that's definitely something we've seen this year. But all in all, investor confidence is high, and that's driving US stocks to outperform. Global economic growth is also strong, and that's why we're actually seeing like emerging markets do really, really well. European equities are recovering. That's what this is telling us, and they're experiencing a rebound again. That's exactly what we're seeing in the global markets, but there are some inflation concerns, geopolitical tensions are present, and that's supporting gold price, along with the fact that there's definitely rate cuts, easier monetary policy on the table, and gold tends to outperform in an environment where there's uncertainty as well as easier monetary policy. Bonds and cash are less attractive, suggesting a preference for higher yield assets, both here in high yield bonds as well as just stuff like stocks and equities as a whole. But despite the risk on fever, CNN's Fear and Greed Index continues to remain here in the fear category, despite the market making pretty much new all-time highs every single day, if not closing highs, definitely intraday highs. And you can actually see a week ago we were in fear. In fact, the last time we actually were in this greed area was actually about a month ago. Now let me explain to you guys why we are in the fear territory despite making all-time highs in the S&P 500 in the last week. CNN's Fear and Greed Index is actually comprised of 7 indicators equally weighted, and they rate them pretty much on extreme greed, greed neutral, fear, extreme fear, and then sort of weight them accordingly. Now they have this market momentum indicator, which they just calculate the S&P 500 and its 120-day moving average, and they look at the distance to and from and then decide on extreme greed, greed, neutral, etc. This right now is in extreme greed. Then they actually have market breadth. They look at stock price strength, their net 52-week highs and 52-week lows on the New York Stock Exchange. Then they actually have a look at the Macallan Volume Summation Index. Now both of these are actually in extreme fear, as you can see right here and as you can see right here. The thing with having 2 market breadth indicators in a model like this is that both of them are almost always going to read the same thing, and this skews the data to one side, because when you have 2 out of 7 indicators saying the exact same thing, it's pretty much 30% of the weight is going to be in favor of this rating right here. So if these are in extreme fear, if market breadth is really bad, this indicator is going to be skewed. We do know that the rally in the last 2 to 3 weeks has really been predicated on Microsoft, Apple, NVIDIA, semiconductors, pretty much just big tech, the Magnificent Seven, excluding Tesla, in fact including Tesla, and that's why CNN's Fear and Greed Index is actually in the fear zone while the market continues to make new all-time highs. And don't ever forget, guys, when it comes to stocks, when it comes to the financial markets, and when it comes to life in general, the devil is always in the details. Now let's talk about market breadth, market composition, and the top 10 stocks in the world. Now the PE ratio of the top 10 stocks in the S&P 500 is 28.1. The remaining 490 stocks is 17.6. The S&P 500 at itself is 20.5. You can see the weight of the top 10 stocks in the S&P 500 is 35.4. Kind of crazy when you think about it. However, not that crazy when you compare it to their earnings contribution. Earnings contribution of the top 10 stocks is actually at about 27%. So the concentration risk actually matches the earnings contribution. Very interesting when you look at it like that. Yes, there is a bit of divergence, but sometimes that is the case, especially when you have a runner like NVIDIA, which is diverging from its fundamentals, but that tends to happen when you have huge, brand new, innovative secular trends like AI. Now, with that in mind, what are fund managers doing? This right here is the NAM number. It just tells us the percentage of US fund managers exposed to US stocks. US fund managers are sitting on about 80% long US equity, so very bullish. This can actually go above 100 to levered long, and right now we're sitting at about the 85 level, and this right here is just another indicator showing us that we are in a risk-on environment. Now with that in mind, what are fund managers actually buying? Now this right here is CFTC non-commercial positioning, and essentially what they're buying, and you can see it's very obvious. Now fund managers are actually long across a broad range of indices, but generally speaking, you can see fund managers are buying volatility. They're buying the S&P 500 over the Nasdaq. They're buying longer duration treasuries over the shorter duration, and they're also looking at copper and silver over gold. I would say to me that this screams more risk on than it does safe haven, especially looking at the VIX with the main equity exposure, longer duration, which is inherently more risky, and then copper and silver over gold, which is normally the safe haven commodity. I would say even in commercial positioning, what we are seeing is more of a risk on fever than we are risk off. If things were looking risk off, you'd probably see more 10-year treasury, more 2-year treasury, probably more weight to gold and more weight to the S&P 500 over the VIX. Now let's actually talk about the biggest stock in the world. We got a note from BofA. They say fundamentals, valuation, opportunity solid despite the stock's steep climb. Solid fundamentals, compelling valuation to cushion volatility. Nvidia stock steep climb up 50% in the second quarter versus S&P 500 up 4.4% could make it vulnerable to near-term profit taking. However, any volatility could be short-lived since, number one, Gen AI hardware deployment is still in only year 2 of what could be a 3 to 5 year deployment cycle with 300 billion plus in long-term opportunity, 3 times versus the current year. Number 2, benefits of NVIDIA's next-gen purpose Blackwell AI accelerator systems will start later this year, with solid demand visibility across cloud customers. Number 3, on-premise, enterprise and sovereign AI demand plus software monetization in the early stages. I'm not sure about sovereign AI, I don't know what that means. Number 4, valuation is compelling at 35 to 40 times consensus and only 30x PE on bull case at $5 a share earnings scenario. Less than 1 times the 50% plus PF EPS compounded growth rate annually from CY23 to 2026. Nuts. Quarterly EPS has 6x'd well ahead of the 4.5% stock move since the seminal second quarter 2024 earnings call that jump-started this cycle. Unlike the dot-com boom that was funded by risky debt-taking, Gen AI deployment is a mission-critical race between some of the best-funded cloud customers, maintained by on top pick NVIDIA. So long story short, runway is long, NVIDIA is the leader, valuation still looks compelling, EPS has 6x'd while the stock is only 4.5x'd in the same time. Kind of crazy, I didn't realize that. Long story short, we may get short-term weakness, but we probably go higher because the valuation is compelling. And here's the thing, if NVIDIA has gas in the tank, the S&P 500, Nasdaq 100 will follow it higher. Don't fight the trend, ride the trend. Now guys, let's talk about the macro. So yesterday we got some data, really terrible data. Jobless claims, housing starts, building permits, Philly Fed manufacturing. Now there's a note here from Goldman, just interpreting the data they got. Now they say Philly Fed edges lower, housing starts drop, claims remain elevated, lowering their second quarter GDP tracking to 1.9%. Bottom line, the Philly Fed manufacturing index declined against expectations for a slight increase in June. The composition of the report was mixed with increases in the new orders and employment components, but a decline in the shipments components. Housing starts dropped 5.5% in May from a downwardly revised April level against consensus expectations for a slight increase and the lowest level since June 2020. Building permits also decreased in May against expectations for a slight increase. Initial jobless claims fell slightly to above consensus expectations, remaining 25,000 above the average level seen in the first 5 months of the year. We lowered our second quarter GDP tracking estimate by 0.1 percentage point to 1.9% quarter over quarter, and our Q2 domestic final sales forecast by the same amount to plus 2%. And Goldman pointed out plain and simply, the weaker data that we're seeing is simply leading to lower growth. Now it is only 0.1 percentage points, but if we do get week after week after week of weaker data, we will start to see GDP tracking go from 1.9% to 1.8, 1.7, 1.6. So we do need to keep an eye on these economic growth indicators. One thing I will disagree with Goldman here is they say claims remain elevated. Let me show you why that is not the case. Now with the initial jobless claims, yes, it did miss, but it was a slight miss. Now a lot of people are looking at this data and saying, hey, we've missed every single week for the last 5 or 6 weeks, except for here towards the end of May. But you actually have to look at it in context with continuing claims. And if you actually look at the actual versus the previous, this is the revised number. Continuing claims are actually beating expectations in every single result. So while initial jobless claims are missing, continuing claims are actually beating expectations. In other words, people may be losing their jobs, but they're actually finding jobs really quickly as well. And we do know this because non-farm payrolls have actually beaten in 5 of the last 6 prints pretty much from the start of the year. We beat in Jan, Feb, March, April. We missed here in May, and then we beat here in June all over again, 272k against the forecast 182. And at the end of the day, I truly believe as long as the labor market remains robust, the economy will continue as usual. Something else we're seeing with regards to people and their job is actually income growth continues to outpace inflation. This is headline PCE and personal income ex transfers, and you could see that income growth continues to outpace inflation, and this means consumers are gaining pricing power against inflation. And I do expect this to continue, although to level out for the rest of 2024 into 2025. And this right here is part of the reason why Apollo Research actually believe that the consensus forecast for consumer spending are too low. And they do believe that consumer spending is actually going to be pretty robust heading into the second, third, and fourth quarter here of 2024. And they do believe that it's actually going to beat on the upside. Our expectation is 2.2%, 1.6%, and 1.6% here in the fourth quarter 2024. And as long as consumer spending stays robust, GDP will continue to chug along as it always has, simply because consumption makes up 67.8% of total GDP. We do know that government spending will continue to remain robust in an election year. 17.5% of GDP is government spending, then investment ex housing 13.7%, and then 4% housing right there. So despite the weaker building permits and housing starts numbers we got yesterday, it shouldn't have a massive effect on overall GDP because housing is only 4% in total. Now let's talk about next week, guys. So we have quite a number of notable names: Carnival Corporation, some cruise liners, a great barometer for the consumer here on Tuesday, especially the discretionary consumer. And then we have FedEx after the close on Tuesday. Then we have paychecks. I'm actually going to be very, very interested to see what they do. I recently took a very small position in a stock called Paycom, and it's just going to be great to see what they do. Now, it's especially great that they're reporting here closer towards the end of the second quarter. So to look at their guidance would actually give us a good indication as to what the stock is doing for this quarter and maybe what Paycom and other similar payroll software companies might do. Then we also have Micron, BlackBerry, Levi's, Concentrix, and then on Thursday we have the big boy Nike from the discretionary space reporting, and that's pretty much it. So it's really just here Tuesday, Wednesday, Thursday. But then when it comes to data, we have a pretty big week on data. The focus will be on personal income outlays. This is PCE right here, and then first quarter GDP print, as well as University of Michigan sentiment, and then housing data as well. So we got GDP data quarter over quarter seasonally adjusted figures. We expect that to come in at 1.5%, personal consumption at 1.8%, GDP price index at 3%, and then core PCE quarter over quarter at 3.6%. This is going to set the tone for the week here on the 27th. Then we also have the PCE personal income outlays. The expectation here, the consensus overall is 0.4%. Headline month over month to come in flat at 0%. Year over year headline 2.6%. Then core month over month 0.1%, and then core PCE year over year. Now both as estimates, they actually expect the year over year figures to come in line as per the consensus, but they do expect the month over month figure for the core and headline to come in slightly higher than the consensus at 0.2 and 0.1 versus 0.1 and 0% against the consensus. And then we also have other stuff like initial jobless claims, new home sales, mortgage application, consumer confidence by the conference board, the personal savings rate, personal spending, and then purchase management index. So a big week of data, a very light week of earnings, but definitely going to move stocks in certain sectors. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.